Welcome to the Professional Website Investors Podcast, the show where we talk about what it takes to successfully buy, operate, scale, and sell a thriving e-commerce business. When it comes to doing business online, we believe that buying an existing website is far superior to building one from scratch. So, if you're a career professional who is looking to become an e-commerce store owner, listening to this show will give you the knowledge, tools, and community support you need to be successful.
I'm your host, Ryan Cowden, and this week we're joined by Ian Bond from ProfessionalWebsiteInvestors.com. In this episode of the Professional Website Investor Podcast, Ian and I discuss a new framework for online investing. If you're at all familiar with investing, you've probably heard of the venture capital investment culture of Silicon Valley. Venture capital involves individuals and teams investing capital in startup businesses, assuming some risk up front in the hopes of a big payoff down the road. Some of the biggest brands you know of today started because venture capitalists invested in them when they were small startups operating out of garages, basements, and dorm rooms. Today we consider if that startup approach could translate into website investing. Is it possible to approach websites as startups and nurture their growth the way a venture capitalist might? Our host, Ian Bond, thinks there's a clear path here and explains how the venture capital approach could lead to sound investing decisions when it comes to buying e-commerce websites. On this episode, you'll hear whether you should invest in one website or spread your money around. One large site can be worth more than a few smaller websites, but that may not be the approach you wish to take. Next, Ian explains the venture capital model. This model highlights the importance of starting small to keep the site running, and then investing money where it's needed to facilitate growth. Then, we cover ways to translate the venture capital model to high-ticket drop shipping sites. Ian shares his own story of making this transition and some of the major lessons he's learned along the way. After that, we'll share the minimum amount you should invest in a website. It's hard to find a high-ticket drop shipping website worth investing in below a certain threshold, so keep these dollar amounts in mind when you make your purchases. Then, we'll discuss what you should expect when you buy a smaller site. Smaller sites will probably entail you taking on a lot of the work yourself, as they are usually run by one or two people. If you're looking to buy a small website, you're usually looking to buy yourself a website that you can run yourself. And finally, we'll discuss the difference between buying and investing. Be prepared to buy the website up front and then invest in areas of the website that will help it to grow. If you're interested in incorporating the wisdom of the venture capital approach into your current system, then this is one episode you won't want to miss. There's a lot of actionable advice in this episode, so grab something to write with because you're going to want to take notes. As always, I'll be back on the other side to wrap up any loose ends. So without any further ado, here's my conversation with Ian Bond.
All right, Ian, welcome back. It's great to see you again.
Ryan, good to be back. We got a great topic today. Yeah. So I'm excited to talk about this. This is my own creation, okay?
Oh, okay, great. Yeah, so we're talking about the venture capital approach today, and this is really going to fit with that whole investment framework that you've been rolling out for us. So real quick overview, how does this venture capital approach tie into the investment framework you've been talking about?
Yeah, so, the first, kind of going back in the series of things we've talked about, and I don't know what exact order will be that we'll publish. We put together a framework for investing with a number of variables to evaluate. Then we have evaluated 6 online business models. Then we devoted a special episode to my favorite model, which is high-ticket drop shipping. If you're new to the podcast, subsequently we talked to kind of what it's like to be an entrepreneur. Mm-hmm. And then identified what I consider to be the 3 biggest risks in a newer investment class or investing in a frontier market. And, the next question, and probably the most frequent question I get when I do strategy sessions with people is, okay, you got me. I really want to do this, but, how do I execute this? Do I buy one large site or do I, or what do I do exactly?
Right. Well, that seems like a great place to start. Do you think someone should take all their money and sink it into one site, or is there another approach you recommend?
Yeah, so it's tricky because the one large site is generally worth more than 4 or 5 smaller sites, and the reason for that is that if a site earns $1,000 as opposed to a site that earns $10,000, the multiple that you'll pay on the monthly earnings is going to be higher. We all only have 168 hours every week. People want to spend their time in the most fruitful way they can. Bigger sites trade more expensively. So why shouldn't I just buy one site with all my money? And I will tell you why. Okay. So, the venture capital approach to website investing, as I call it, is comes from watching the folks in Silicon Valley, the VC investors in Silicon Valley, and how they manage funds when they raise their funds. And in the last 2 weeks in my day job, I've had 3 Silicon Valley based VC firms through my office. One actually here from the Middle East also, and they manage money in a very similar fashion. All of them generally, and I'll give you a few metrics. Generally, venture capital fund portfolios are constructed of kind of 8 to 10 companies. Generally, they take smaller investment bites, at least to begin with, to limit their downside. But remember, as we all know, venture capital and website investing has an asymmetrical payoff, so you can have incredibly large payoffs.
Okay.
Third, the investments, are kind of phased in. So as the VCs learn more, they put more money on the table. And then, with regards to the way the portfolio ends up paying off, you can expect some number of the companies that you buy or the websites that you buy to have an outsized payoff. And some of them you will either have made a wrong calculated bet, or the market may have moved against you and something would be unforeseen. But typically, if you look at a venture capitalist's fund returns, they're going to be a couple of home runs. There might be a couple of write-offs, and the other ones will do kind of middling performance. Okay. So, those are some of the things we can talk about.
Sure. So the venture capital model would really be building a portfolio. Is that kind of the what we're
hearing?
So
venture capital is generally thought of as 2 guys in a garage.
Yeah.
And I would say that what I would do and what I do is I'm not buying something that is so nascent that it would be what I call seed capital. It would be more growth capital. And there's a very big distinction in that. And there's a great book called Angel, written by Jason Calacantis, that talks about really the seed guys and what they do. But I look at myself as someone who looks and finds what looks like it's a proven business model. It's got some metrics which we can get into in another podcast that give you some comfort that it's sustainable. It doesn't have a long track record yet, and it looks like it can scale, but it's not 2 guys in a garage.
Right.
So,
right.
Okay. So, originally, what we did is, and this was after over 50 deposits with one website broker alone. And this is after, having invested in frontier markets for over 36 years, back in the day, I mentioned how long in the last episode, how long I've been investing, it started in the early 1980s. This is when international investing was thought to be sexy. People just invested only in the Dow Jones Industrial Average. But originally we took what was a capital pool of about $250,000, that, I was going to dedicate to investing in websites. And I divided it by 5 to get what I thought might be a good average investment. Mm-hmm. Then I handicapped that number, which is $50,000. I handicapped that by about $10,000 because I suspected I'd need to make some additional investments, or I would have misjudged something, and I didn't want to have, be short of cash. Didn't want to extend myself, mm-hmm. and that's when I started to go shopping. And so, that was the original thinking, back in the day. Now, we're about, I'm sure you're going to ask me how that all worked out, but that's where that was the jumping off point.
Okay, great. Yeah. Well, let's connect those dots there. So how does that approach specifically translate into high ticket dropshipping, which is where we're moving towards? Yeah.
Yeah. Okay. I'll give you the history on what we did. Okay. I'll give you the history on what we did, and I'll update that because that's now 4.5 years old. Let's see, 2000, and it's kind of 3.5 years old. So our first 2 purchases were $17,000 and $25,500 in October and November of 2015. And I'd say that since then we learned like 2 really big things that people can profit from hearing about. First, I'd say that $25,000 to $35,000 is kind of the bare minimum to get that, what I call proven business that gives you the sense that you've got something that's really worth investing in. Now we're taking our minimum up, from $50,000 and going higher, going back to the limited time in the day, because we now kind of feel like we understand things, and we actually want businesses that are more proven, and we want to pay more money for them, and we're willing to pay more money for them, because we just have, I think, more confidence. The second thing that we did back then was that, we first bought, and then we did like the VCs do. We invested more. And I think that buying and investing is an excellent strategy, because after you've owned something for a while, it becomes really obvious to you, where you can, put more money to add value to what you own. So, get something that, it's got some scale and some stability, and then, buy it, get acclimated, and figure out how you can invest and grow it. And, you can monkey around with the numbers, but I think kind of the bare minimum these days, is it's north of $25,000 for sure.
Okay. So that's the bare minimum.
Yeah.
I like hearing that when you want to make a change, you don't necessarily have to go buy a different website. You can put some of that money back into the websites you already have and scale it up or add a different dimension to it.
Yeah. I mean, absolutely, there are going to be opportunities for you. Some when you are identifying a website, one of the things you have to do is kind of have a checklist of where you think there are opportunities, and then figure them out. We have looked for places where we can add value, scale things, where potentially we can expand the niche, add more suppliers, invest more in content, all those types of things. So it's absolutely the case that if you plan from the get-go, you hopefully can add more money to it so that you can grow it much larger. Now, in our first site, the $17,000 one, there really wasn't much we could do. That was a big mistake and a big learning. And our second one, it's in a massively large niche, and you could say that we bit off more than we can chew. It just happened, it certainly seemed like it for a long time. Now 3.5 years later, it's worked out, exceptionally well. And we're starting to feel like, we actually belong in this industry. You start to get comfortable. So,
sure.
But maybe we should talk about, kind of what you get at the low end.
Yeah.
If you're looking, kind of at the minimum site or what you should look for. Okay.
Sure. Let's do that.
Yeah. So, if you're going to spend as little as, 25 or 30 or $35,000, what do you get and what do you want to get? Well, you want to get at least 2 years of operating history in general. Oftentimes a website broker will say, well, we're pricing this on the last 6 months earnings because we think that's more representative. That's a red flag. It hasn't operated at that level if they're using 6 months and not 1 year. Generally, the rule of thumb is 1 year. A $25,000 site isn't likely to be earning much more than $1,000 a month. And this is big. You're going to be doing everything on that website because that seller is doing everything. And so this is a really early stage website. And you wouldn't call this a real business yet. When the seller is a jack of all trades, you're not talking about a business. You're talking about a website. And to be clear, people pay more for businesses than they do pay for jobs. Okay.
Yeah.
And so most people are looking at website investing as being something that is semi-passive, if not entirely passive. So if you're going to buy into something where you've got to do customer service, pay per click, upload products, supplier relations, you're going to be spending a fair amount of time doing it. And this is a big issue. So this is really the major reason that we raised our minimums and why we're going for bigger sites. In addition to that, if you see a bigger site with a glaring opportunity, so let's say, and we see this all the time, the biggest glaring opportunity is that people have not focused on, valuable SEO. And, that's something that you want to pounce on. And if you see a big opportunity like that, don't fool around with a little site, go for a big one.
Okay. Interesting. Yeah. So where do you find that line is, that price line where it's no longer a website, but it's a business? Is there a dollar figure?
Well, I think it's when the earnings cover the functions that I just mentioned.
Okay.
And then so that's customer service, that's pay per click, that is, some allocation to have developers updating the site for you. Most people won't put that in there. And then the other function that would be the last thing that I would outsource. I don't recommend anyone outsource this, would be the supplier relations. That's something that the owner should do.
Okay.
Number one, you keep your pulse on the business and you keep your pulse on what's going on in the industry. But number two, they're your gold, and you want to maintain those relations. So, but when you see a website where all of those things are accounted for, and the monthly number is X, and you're paying a multiple of X, that's when you've got business economics as opposed to the economics of just buying a website, buying a job.
Yeah. Great. You made this distinction a couple minutes ago about buying and then investing, and I was wondering if you could explain a little bit about the difference there.
Yeah, so go back to what we said that a good venture capitalist does.
Yeah.
What happens is they seed smaller startups that raise seed money first, and they have to hit milestones. And as the venture capitalist sees them hit milestones and everything proves to be economic, their model works, they raise another round of financing. And, this is essentially what we're trying to replicate by, this VC strategy that we're employing. You buy it with, kind of that seed capital, and then you operate it, and it seems like it's going okay. And you figure out where, you can make more money, and, you throw gas on the fire. And so this is kind of, what I would call a toehold strategy in investing. And, you add the cash where you think that you're able to get a big return. And, as I just mentioned, The one that seems to be, kind of the biggest opportunity that we're seeing right now is people, especially in the smaller sites, they've just not focused on SEO related content. An area that we've been very successful is adding additional suppliers where you can broaden your product catalog. We've talked on this podcast on the systems and processes we employ and the fact that we use virtual assistants. Those would be three of the big things that I would include in buying than investing.
Okay.
It could be it could be any number of smaller things, but those would be the big ones that I would say that we would look at. And it all depends on the site. It's exciting. It won't become incredibly obvious to you until you buy the site in some instances. In some instances, after you've looked at a lot of sites, it'll just jump out at you.
Okay. So you buy the website first, and then you figure out where to invest in the website, how to build it up.
Yeah. So, you essentially, with buy to invest, you kind of add to a winning bet, and, you exploit the opportunities you see, while you've kind of limited your initial downside, if that makes sense. That's what a venture capitalist is trying to do.
Okay.
And, that's what we were trying to do when we began. I think it's a smart thing for people the way smart people think. I do know people that have taken, one big swing at things, and, I haven't heard any horror stories, but I'm scared for them. So,
yeah, right.
There's just so many things in the world of website investing to be concerned about. Google changes things, competitors change things, Amazon does things.
Yeah.
You can't, it's like investing in the stock markets globally. One of the reasons I love being a wealth manager in my day job is that every morning you wake up and the world is a different place, and it gives you an opportunity to solve for what those opportunities are. But when you have a lot of money on the line, Ryan, you may want to be, thinking about your initial downside first and saving some money for a rainy day, as opposed to putting it all out there on black or red right away.
Okay. Great. Well, Ian, this was great. Thanks for laying out the venture capital approach for us. Is there anything you want to say just to kind of wrap this up for us?
I think the venture capital approach to website investing, I'll trademark that. So, that's, love to have anybody else's comments on it. But
sure.
I think it's a valuable way to start. And I'm not saying that you should do 4 or 5 websites like this to start with. Certainly don't do 8 or 10. But I do think it's a good way to think about website investing. Particularly think about, how to limit your downside on the get-go. And then literally every time you look at an opportunity, figure out if you can identify the ways where you can buy then invest, should things go the right way, Okay. And if you have those 2 disciplines in mind, I think you're going to be way ahead of the crowd, and you'll have your downside limited with a great deal of upside. So yeah, that's it.
Okay, great. Ian, this was great. We'll see you next week.
All right, Ryan.
All right, bye.
All right, folks, there you have it. That wraps up my conversation with Ian Bond of Professional Website Investors. He shared a ton of valuable insights and advice today on the venture capital approach to online investing. We also shared some tools and resources, which will all be linked up in the show notes at professionalwebsiteinvestors.com. I hope you enjoyed our conversation. Please consider subscribing, sharing with a friend, or leaving us a review in your favorite podcast directory. Until next time, best of luck in all that you do, and we look forward to seeing you on the next episode of the Professional Website Investor Podcast.